Vikas Khemani, President and CEO of Edelweiss Securities, joins us right now on the show. Vikas, good morning. Thanks so much for joining in. Unfortunately, it doesn't seem like that the morning will be good. My question is, how damaging could this be for market sentiment? We already have a 2% downtake at hand. What more?
Good morning, Neeraj. I think obviously, it is given that market will open gap down, which could be 1.5, 2%. And, I do believe that this kind of reactions was expected when this kind of, landslide victory has happened in Bihar. But I think we have to understand what could be the impact of it from a medium term to long term perspective. I think government has a clear majority as far as the central government is concerned. They can very well continue their executive and administrative efforts. There might be a little bit of a challenge in the legislative process, but I don't think that is going to be a big hindrance at this point in time, because I think what Indian economy at this point in time needs very much is some sort of uptick in the investment cycle, some sort of spending in the economy, some sort of pickup in the job creation, and for all those things, and I'm talking purely as far as the markets are concerned. So all those things necessarily do not depend on the legislative process. Some of the things like GST, land bill, where the legislative process could be possibly difficult given these results, and if the opposition unites, that can wait for some more time. I mean, there will definitely be efficiency improvement measures, but does not mean that without that economic recovery cannot happen, without that corporate profits cannot grow. So I think if after this results, if government gets back to business with little bit more seriousness, with little bit more urgency, to see that the efforts go down to the ground very quickly, I think that would be really sort of good, and I do believe that this event probably could trigger that. Other than that, I think market will get back to normal business maybe after in the next couple of days. We have a Fed rate hike, Fed rate event ahead of us, and then I think we have a lean season, next 1 month. So I think, in my opinion, markets are going to, get over with this issue in next, maybe this week itself, and then we will have to see how things are moving on the other larger factor. I think, in my opinion, bigger factor going forward would be a Fed decision. This would be forgotten, I think, with this today's event. I don't think this could lead to a big one-way sell-off or a very big deep cut. I think probably today or maybe tomorrow, the impact of this particular thing should be over, and market will wait and watch and see how things pan out on political front. But they are not going to change in a day. I think there might be a situation where some people might question on the legislative side that it might not happen. But I think anyway they were not happening for last almost a year. So the way I would like to see is, come January, you will start seeing expectations around budget getting built, and then probably given this event, budget could be a lot more effective. There could be a lot more actions coming through. So I think net I feel that market should settle down 200-300 points down from from current levels, and then look for the next quarterly earning, which is probably December or March.
So, Vikas, while the markets try to find their feet, what's the message out to investors who are looking at building their portfolios from, say, a 6 month to 1 year time frame? Do they buy these dips, or do they wait for all the uncertainty regarding next earnings season, regarding the budget, or more importantly, the near-term Fed rate hike, which seems inevitable now in December? Do they wait for these event risks to get done, or do you think right now the dips that are going to come in the next 2 to 3 days are good time as any?
See, I would believe that any dip which comes would be a good opportunity to buy, for the simple reason. I think one is, I mean, today anxiety would be very, very heightened, given the fact the outcome comes, and whenever any outcome, extreme outcome comes, either it is on exuberance side or on the anxiety side, it is always a bit extreme. So you might see market getting a bit overextended on the cut side. And I think that would be great opportunity, for the simple reason. I think we don't have any threat to the government at the center. Secondly, I think we must not forget that from macroeconomic perspective, economic bottoming out of the cycle is happening. We are recovery is around the corner. all possible things, whether it is commodity prices, interest rates, picking up the investment cycle, all are around the corner. So if you are looking from a 12 months perspective, this would be, in my opinion, godsend opportunity to sort of build exposure. Let's not forget, last 12 months equities have not delivered any significant returns. So I mean, you have had 1 year of again bad markets. So in my opinion, this would be a great opportunity to build portfolio from a medium term to long term perspective. There might be a situation, because of the global situation, there might be a little bit more cut where market might fall, which at this point in time will be difficult to predict how the Fed rate event will pan out. But at this, even if you look at when Fed rate issue was there last time, market didn't fall below 7600. So I would be surprised even if this time around market really falls below that, because I think market is sensitized to a great extent on the Fed rate hike issue. So broadly, I would say this range of 7576 to 77 7800 is a good range to build a portfolio. From a medium term to long term perspective. Even valuation wise, it is not very expensive around these levels. So I think net all things sort of converge around these levels. So I would be very comfortable allocating more money towards equity at these levels.
Vikas, the grain of truth is that for those who bought stocks, let's say in May 2014, they've not made very handsome returns. Nifty has given a return of just 9%, which is even worse than fixed deposit. And the best performing sector actually is healthcare, followed by autos, which has got nothing to do with policy or reforms. So rather than talking about what the government should do, will do, and the fact that government action will translate into economic recovery, the fact of the matter is that so far those who betted on economy and infrastructure stocks, they've not made money.
Absolutely, Nikunj. I think we must analyze this in two parts. One is that the large part of the stock performance in the sector which are leveraged to the economy got built in before even the election outcome came, in expectation of that. If you look at L&T, almost doubled from 700 to 1500 rupees before even just around the election time. So I think large part of this thing got built. Now obviously and similar things were there in the banks, similar things were in other economically aligned sectors. Now I think market that point in time hypothesized that all these things, problems will be quick to solve, and I think things will start improving the moment government came. But unfortunately it did not happen, and I think it took some time. But if you analyze the actions of the last 6 to 8 months, I think a lot of things have been happening in that direction. I think first 1 year government controlled spending, got the fiscal deficit in check. But now I think in last 6-8 months government has been very aggressive in terms of infrastructure spending in particular, and I think that takes time to percolate down, whether it is railways, roads, or lot of other urban infra projects, and I think that takes time to percolate down. So in my opinion, and we've been very closely watching what's happening to the those segments or order books of those companies, and I think there is definitely uptick, and that will take time, and our hope is that over next 6 to 8 months that will start reflecting. So I think I would say patience is running out. Last 1 year markets have not given the return, but probably time to give up is not when the patience is running out, maybe, because I think if you look at any macroeconomic factors, they are right now sort of showing a lot of hope and optimism. So when interest rates are coming down, capex cycle is picking up, it might be delayed, but it generally should not be possible that markets don't give return. So I think we came out of high expectations, but those expectations sort of settled down, and I think right now we are in a situation where there's a lot of skepticism, expectations are sort of controlled. So maybe when this kind of environment is there, this is a very conducive environment for long-term equity, and when you have to buy when everybody is sort of running out of patience or sort of giving up on the markets.
The ever so optimistic Vikas Khemani. Vikas, always good chatting with you, and here's wishing you and your entire team a very happy Diwali from all of us.
Thank you very much, and wish you the same.
Thank you.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.